cash is king. Don't get me wrong, cash might be king, but let me tell you, credit is the queen. And we all know who runs the palace, right? It's always the queen. Credit card is a good thing. Having credit is a good thing. Hey guys, welcome back to my channel, Faith, Family, Finance. In today's video, we are going to be talking about credit scores, and we are going to be talking about the 5 categories towards a credit score, and we're also going to be covering why credit is so important and the benefits of credit and how you can take advantage of those benefits for yourself, and also ways to improve your credit score. So continue watching the video. You hear the saying that cash is king. Don't get me wrong, cash might be king, but let me tell you, credit is the queen. And we all know who runs the palace, right? It's always the queen. Credit card is a good thing. Having credit is a good thing, despite of what we heard before or whatever we was taught that credit card are bad, that we should cut it up. Credit card is not a bad thing, especially once you know how to use it, you know how to manage it. I look at credit as a source of income, especially when you're using it wisely. Credit cards should be used for you and not against you. There are 5 main categories that are used to determine your credit score. You have your payment history, you have the amount that you own, which is your utilization, you have the length of your credit history, your credit mixture, and also the inquiries, like how many credit cards or how many lines of credit are you asking for, which is your inquiry. We'll talk about the one that makes up majority of the credit score, which is your payment history. Your payment history makes up 35% of your score. That is a huge right there. That's a huge percent. So if you're seeing your score like decreasing, or you're seeing your score not at where you would like it to be, not in the fair category, look at the way that you're making payments to those cards that you have. Are you making on-time payments, right? Are you waiting for after the statement date to pay your credit card or to pay your loan that you have? So make sure that you're looking at those things, because that's the huge category that affects your credit score. Next, we're going to talk about the amount that you owe. That is usually called your credit utilization, and that is the amount of debt that you have versus the amount of credit that you are approved for on your report. So for example, if you have, let's say one car you have $1,000 and another car you have another $1,000, you want to make sure that you're not maxing out both of those cars, because if you're spending $1,000 on this car and you spend $1,000 on this other car, your utilization right now is 100%. That means you're using 100% debt, 100% of the credit that you have. And we all know that credit cards and loans are not assets. These are liability towards you. So you want to make sure that you're not utilizing all of what you're approved for. I know it's always recommended to stay at least 30%, but I would always recommend, especially if you're starting or if you want to see your score dramatically increase, to always stay within 10 to 15%. If you can even go lower than that, that is perfect. We have the amount that you owed, which is called your utilization. This is the amount of debt that you have compared to the credit amount that you have on your account. For example, if you have $1,000 on your Chase card, you have another $1,000 on your Discover card, you do not want to be maxing out $1,000 on Chase and also maxing out $1,000 on your Discover card, because that means that your utilization rate is currently at a 100%, and a lot of lenders that do not want to lend out more money to people that are utilizing all of the credit. That means you don't know how to manage your credit correctly, right? So that makes up about 30% of your credit score. That is another huge amount, a huge percentage of your credit score. So you want to make sure that you're utilizing that wisely, and a lot of time they recommend staying within 30% of your overall credit. But I will always recommend, especially if you're trying to increase your score dramatically and you are also trying to just be better management at your money, to always do 10 to 15%. That means you're only using about 10% of your overall credit. Next, we have our length of our credit history. This is also another important category. This makes up 15% of your credit score. So your credit history is just the how long that you've been having this credit. So a lot of us, like myself, got our first credit card in college. Why do credit card people think they can go to college campus and try to get us that have no idea about credit cards? But look at that, it's also a good thing. In my case, it was a good thing. I got my first credit card with Discover when I was in college, which was in I got it about 2012 or 2013. Around that time, I've been having that card for about 9 years or 8 years now, right? That's been a good thing on my report. And because of that, I was able to, I think I explained before that my husband didn't really have credit cards. That's not his thing. He didn't carry any credit card. So when we both were starting his credit background, we decided to use my Discover card to add it to his report. So now, because I had that card for so long, that is a good effect on his credit report. So making sure that you're not closing accounts just because you're not using the card. Do not close the credit cards. Next, we're going to talk about your credit mixer. So your credit mixer or your credit mix is just saying that you're able to handle different type of credit well. So you have your installment loan, you have your revolving loan, your open credit, your line of credit, and all these great things are just telling the lenders that you're able to handle various credit well. Lastly, we have the inquiry category. So the inquiry category is just when last you apply for credit. So that's when last are you begging and asking someone to give you credit. You want to make sure that you're not out there just going everywhere and just applying for things, because a lot with the hard inquiry, that's going to harm your credit report. It's most likely going to cause a decrease in your credit score. So just keeping that in mind before you go out there to apply for credit. Make sure that you're looking at your report and you're seeing when was the last time that I asked someone to give me money, right? So there's two different types of inquiry. You have your hard inquiry, you have your soft inquiry. So with your hard inquiry, that's like your hard pull, such as your mortgages. When you asking banks and lenders for money for mortgages, they're doing a hard pull. They're looking at every single thing. And also with car loans, they're also doing a hard pull. But with the soft inquiry, that's, for example, we used earlier, you have your bank, you have a credit card line already with Chase. Chase wants to give you more money. Chase is just going to do a soft pull in your report. So they're just tweaking little things here and there to be able to approve you with a higher increase in line of credit.